going to be presenting the Laffer Curve. This is the original graph that Alt Laffer wrote on a napkin in Washington, D.C. There is nothing wrong with this graph, but graphs can become confusing, so we wanted to make it simpler to understand. The only thing the Laffer Curve addresses is the tax rates. Economics is very complicated because it is affected by many factors, such as tax rates, regulations, deductions, exemptions, stability of currency, total spending, and tax credits. Taxable GDP stands for gross domestic product that is taxable. Taxable gross domestic product is all the product and services provided for in a country in a given year that can be taxed. In the Laffer Curve, we only talk about taxable GDP. Taxable GDP is the money you make that can be taxed by the government. This does not include income that is deducted, exempted, or labor you do yourself. The percentages down here are the tax rates. The line up here is the taxable GDP line. This graph is saying that the taxable GDP will stay the same as tax rates increase or decrease. The Laffer Curve does not assume this. This line represents the amount of money the government is getting from the taxes. This graph is saying that taxable GDP will stay the same as tax rates increase or decrease. This assumes that taxpayers' thoughts and actions do not change with changing tax rates. Congressional Budget Office, the CBO, uses this chart. The Laffer Curve believes that taxpayers' thoughts and actions do change with changing tax rates. As the tax rate increases, the benefit of the profit is greatly reduced. Thus, entrepreneurs are less likely to start, expand, or might even have to close down a business. Pros of a business: profits. Cons of a business: your own labor and time, and expenses. As tax rates increase, the weight or worth of a profit is greatly reduced. A trade of product or labor only happens when two people agree on a mutual cost that benefits both people. If they both decide that it is fair to trade 10 chickens for 10 stalks of corn, and the government has a 50% tax rate, then each person will give 10 of their items away and only receive 5 in return. The government is taking the other 5 products from each person. The more the government taxes, less people are willing to work. If people stop trading completely, the government's income will cease to exist. Now we are going to look at the logic of the Laffer Curve. It shows us that people's thoughts and actions do change with changing tax rates. Unlike the other graphs, this graph is what the Laffer Curve assumes. The higher the tax rate, the less people are willing to work. Let's first look at this line so the Laffer Curve will make a little bit more sense. Labor you do yourself is not taxed. Buying things is important because it allows people to focus on one thing and get good at doing that thing. When the tax rates increase, people do not see worth in buying goods, so they try to do things on their own. This is not nearly as productive. This is called comparative advantage. 100 represents the maximum amount of taxable GDP that can be taxed. 0 represents when the government taxes 100%, so we are no longer willing to work. The reason why the taxable GDP line is diagonal is because people's willingness to work is increasingly less as the government taxes us. If the tax rate stands at 40%, $6 is the full taxable GDP. People will have a hard time seeing the potential unrealized at this point. Now we've added some lines. We have already talked about the blue diagonal line in great detail. It shows us how willing we are to work when the government taxes us. The percentages down here is still the taxation by the government. This purple line shows us the income from the taxes. It is the actual Laffer Curve. The green line shows us how much money we get to keep after the government taxes us. Let's look at the math. We are going to take the amount of taxable GDP we are willing to make, then subtract the percent that the government is taxing us. After that, we will be left with the money the people get to keep. So 0% of $100 is $0. I'm sorry, 0%, yeah, 0% of $100 is $0. At a 0% taxation rate, you're willing to make $100. So 0% of $100 is $0. We get to keep $100 and the government gets none. Now, at a 30% taxation rate, you're willing to make $70. 30% of $70 is $21. So we get to keep $49 and the government gets to keep $21. At a 70% taxation rate, you are willing to make $30. 70% of $30 is $21. We get to keep $9. At a 100% taxation rate, you are willing to make $0. 100% of $0 is $0. Both the government and us only get to keep $0. We have to know when to stop taxing. As we saw, if the government taxes us too much, then we are no longer willing to work. People then start trying to do things on their own, and this is not nearly as productive. The higher the rate of welfare, the less economic activity. If the government gives us things, we are not willing to work for it. The total amount of people on welfare today is approximately 15 million people. $132 billion is spent on welfare alone, not including food stamps or unemployment. This forces the tax rates higher, thus reducing GDP. Exemptions and deductions are counterproductive. Exemptions and deductions are when the government makes too many exceptions on too many circumstances. Too many exceptions on what is taxed and what is not. When government makes too many exceptions on too many circumstances, they realize they aren't getting enough tax revenue. So they raise tax rates. Now, as we learn, they aren't going to raise enough tax revenue. If you have a 30% taxation rate and you have a taxable GDP of $70, the government collects $21. If you then exempt 50% of the GDP, then the government's income drops to $10.50. You will never be able to raise rates high enough to get back to $21 because taxable GDP drops as you raise the rates. It is far superior to low tax rates instead of using deductions and exemptions. Having a progressive tax rates are similar to large deductions. One low flat rate will result with no exemptions or deductions will result in a much higher GDP. This will result in higher employment and higher pay. Thank you.